Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 328 on June 21st, 2024. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Riot Platforms, Hut 8 Corporation, and Intel Corporation. And we discussed three new trades on the ProShares Ultra Bloomberg Natural Gas ETF, Carnival Cruise Lines, and the VanEck Vectors Gold Miners ETF. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the U.S. equity markets finished this week higher. The Dow Jones Industrial Average grew 561 points, closing at 39,150 points. The S&P 500 index picked up 33 points, ending on Friday at 5,464 points. Now it's time for the topic of the week. The topic of the week this week is choosing the right strike price. One of the challenges in trading options is that while there may be one or two definite wrong answers, there can be 4 or 5 answers that might be right. That being said, choosing the right strike price for your trades is more art than science. However, I want to point out at least one situation that is definitely wrong. I'll start off with a story. When you work down on the trading floor, you learn to be careful what you say because it just might turn into a bet. Someone might ask you how many crackers you think you could eat in 5 minutes. Your nonchalant answer might turn into a market with dozens of guys you don't even know trading on whether or not they think you can actually do what you just said you could. Literally thousands of dollars might trade on a stupid bet like this, and it can happen any day. One day we were talking about working out. Several guys shared their 1 rep maximum. This is the absolute most amount of weight that you could lift. At that time, I weighed roughly 175 pounds. I told the guys that my 1 rep max on bench was 240 pounds. Immediately, some guys sold it, some other guys bought it. Next thing you know, I'm scheduled to prove that I can bench this much weight the next day. One guy said he didn't even think I could do 225 pounds. Thankfully, I took that bet as well because I knew that I could do that amount of weight. To make a long story short, I went to the gym that night and actually did my 1 rep max. I lifted 240 pounds on bench. The next day, when I was scheduled to complete the bet, my chest was actually too sore and I did not push the weight up. I did, however, make money on that 225 pound bet. I learned a great lesson that day. I likely could have gotten everyone simply to bet on whether or not I could even push up 225 pounds, which I was doing for sets of 5 at the time. By giving them my true maximum, I didn't build in any margin to guarantee success. Now, you might be asking, what does this have to do with choosing a strike price? Everything. If you think the stock will move up to $50 per share, do not buy the $50 call option. The break-even point will be above $50, and you'll likely lose money on the trade even though the stock moved in the direction you expected. Consider the $48 strike or even the $49 strike. Always make sure that the break-even price for the trade that you select falls within the expectation of where you think the stock price will head. In gambling, they call this sandbagging your number. In choosing an option strike, this simply increases the likelihood that you'll win. Always build in some cushion so that you increase the likelihood of winning. Don't choose the strike that is exactly where you expect the stock price to go. All right, so that's it for the topic of the week. Let's go ahead and get into the review of last week's trades. We're going to start off with the covered call on Riot Platforms, Inc., symbol R as in Romeo, I as in India, O as in Oscar, T as in Tango. At the time, the stock was trading for $10.53 per share. I looked at buying stock and selling the July 11 call at 89 cents, hoping for a return of 12.92% in 5 weeks. Well, shares of Riot fell 98 cents, ending the week at $9.55 per share. The out-of-the-money call option that we sold also lost 44 cents, leaving us with a net loss of 54 cents on the week if we were to close the trade out immediately. Now, at this point, we are 9 cents below our break-even point. I would typically look to roll the strike of the option lower, and if we did that, we would collect another 49 cents, but we would lower our overall upside significantly, and the 49 cents that we collect doesn't even wipe out the loss that we had on the week. So for these two reasons, I'm willing to hold on to this trade another week or at least a few days just to see if the share price is going to head a little bit higher again. If it doesn't, my first line of defense will be to roll the strike of the call option lower. But always make sure that you do the math to make sure that the adjustment makes sense for your risk tolerance level. I say this on every show, and you can ask any of my students. I totally mean it. Always do the math and make sure that it makes sense for your position. Next up, we have the credit spread on Hut 8 Corporation, symbol H as in hotel, U as in uniform, T as in tango. At the time, the stock was trading for $11.28 per share. I looked at selling the July 11-10 put spread at 35 cents. That could give us a maximum possible loss of 65 cents per spread. Well, shares of Hut 8 gained $1.07, closing at $12.35 per share on Friday. The out-of-the-money put spread that we sold is now even farther out of the money, which means this trade is moving in the right direction. With 4 weeks left until expiration, we simply hope that the share price remains above $11 per share through expiration. That would allow us to keep the full premium that we collected when we sold the spread. So far, so good. No adjustments are needed on the credit spread. And finally, we had the debit spread on Intel Corporation, symbol I as in India, N as in November, T as in Tango, C as in Charlie. At the time, the stock was trading for $30.45 per share. I looked at buying the July 29-30 call spread for 66 cents. That could give us a maximum gain of 34 cents, or that's a 51.52% return in 5 weeks. Well, shares of Intel grew 64 cents, ending the week at $31.09 per share. The in-the-money call spread that we bought is even farther in the money, which is great. That means the spread made money too, and the share price is well above our upper strike and our break-even point, so no adjustments are needed on this one either. We will need to track the trade over the next 4 weeks just to make sure that the stock stays on the path that makes this trade profitable. Always have a plan for how you'll defend the trade if the time comes. So far, so good on this trade. No adjustments are needed. No defense needed. It's working out. So that's it for the trades from last week. We're going to go ahead and dive into the trades for this week's show. But before we do that, I do want to point out that today, June 21st, was expiration for all monthly positions in the month of June, all June monthly options. So any June monthly option positions that you have on are either trading for intrinsic value or they have gone to zero. So hopefully you made some money. That was a decent month for me as well. Let's go ahead and get into the new trades for this upcoming week. Each of these trades will use the July 19th expiration for monthly options in the month of July. So we'll start off with the covered call on the ProShares Ultra Bloomberg Natural Gas ETF, symbol B as in Bravo, O as in Oscar, I as in India, L as in Lima. The stock ended the week at $18.35 per share. I'm looking at buying stock and selling the July 19 call at $1.82, hoping for a return of 13.46% in 4 weeks. Now you enter this trade by buying stock for $18.35 and selling the July 19 call at $1.82. This trade makes the most money if stock prices finish above $19 per share. The break-even price is $16.53 per share, and in real terms, the stock purchase will require $1,835, and you'll collect $182 for selling the option. Next up, we have a credit spread on Carnival Cruise Line, symbol C as in Charlie, C as in Charlie, L as in Lima. The stock ended the week at $16.06 per share. I'm looking at selling the July 16-15 put spread at 37 cents. That could give us a maximum possible loss of 63 cents per spread. Now you enter this trade by selling the July 16 put at 78 cents and concurrently buying the July 15 put for 41 cents. This is a credit spread because we're selling the spread, and this trade makes the most money if stock prices expire above $16 per share. The break-even price is $15.63 per share. In real terms, you would collect $37 per spread that you sell, and you have $63 at risk. Our final trade on the week is a debit spread on the VanEck Vectors Gold Miners ETF, symbol G as in golf, D as in Delta, X as in X-ray. The stock ended the week at $34.01 per share. I'm looking at buying that July 33-34 call spread for 61 cents. That could give me a maximum gain of 39 cents or a 63.93% return in 4 weeks. Now you enter this trade by buying the July 33 call for $1.84 and concurrently selling the July 34 call at $1.23. This is a debit spread because we're buying the spread, and this trade makes the most money if stock prices expire above $34 per share. The break-even price on the trade is $33.61 per share. In real terms, you'll pay $61 to enter the spread, and your maximum gain is $39 per spread. So that's it for the trades for this week and the review of this week's trades. All in, great show. Thank you guys so much for listening. I will point out that because today was expiration, Friday, June 21st, you'll see different prices being quoted on Monday. They often will start quoting the 50-cent strike. So you might find a better pricing or a better deal on some of the trades mentioned here on the show today and on some others. So that's the hardest thing about making the show on expiration Friday, is that there's so much change that will happen once the market opens on Monday morning. But it's always good. I love that you guys listen along. I know that many of you follow along with these trades because you email me about them as well. So hopefully you're learning, you're enjoying it, and I really do appreciate you guys coming and listening to me each week. Hey, if you have friends that enjoy option trading or that are learning to trade options or who claim to trade options, share my show with them. I'd love for them to hear it. And, if you do email me, I do actually get that email. So if you say something crazy, expect a crazy response back because I'm that guy. But most of you are pretty cool. You send me great questions each week, and I always get a kick out of answering them. So, hey, I hope you have a wonderful weekend. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.